Hi, everybody, and welcome back to Friday Focus. This is Ross Healy, the chairman of Strategic Analysis Corporation. Today, we are going to take a hard look at BCE, probably one of the most widely held stocks in the Canadian universe. And I'm going to start off by going back all the way to 2007, when you notice that first big drop in the price. So what happened here? Well, the Ontario Teachers' Pension Fund decided that it would be interesting to do a levered buyout of the shares. And the calculated price that the levered buyout would occur would be $42.75. Well, with teachers backing it up and the stock trading about $38, $39 at the time, it was an absolute guaranteed easy 8 to 10% gain for investors, and people rushed to load up with the company. However, what was the problem? The problem came when we went looking at the bondholders. What was going to happen to the credit quality of this AAA rated company in that levered buyout? Well, who knew? But to answer the question, they hired Pete Marwick to do an analysis. Now, we do our own credit analysis. So rather than wait for KPMG to give me their conclusion, we did our own. And what happened was that the shares came up tilt, and I was very, very sure that KPMG was going to nix the whole issue, and they did. And when that happened, all of those people that had bought tons and tons and tons of shares for that quick 10%, they had to sell. And they sold in a panic, and you can see that plunging gap there. And the stock fell all the way down to its normal price, its price to book of 1. Well, anytime that you can buy BCE at a price to book of 1, you've got to fill your hat. And we urged our clients to buy every single share that they could. Well, what happened subsequent to that time? The stock tripled from about the 2022 level to about the $60-odd level here. At that point, it reached what I considered to be an absolute peak for the stock, that is to say, its fair market value. And the stock hit its fair market value with precision, and I issued a sell signal at that point. The stock kind of fluttered up there for a while, but ultimately set back here to its mid-growth price. And we said, well, hey, look, there's a nice gain to be had here if it moves back to its fair market value. So we put it on the buy list, and it moved back up there, set back again, moved back up there again. But what was happening? Well, the CRTC was beginning to insist that big major companies like BCE and Telus share their platforms with the little tiddler companies. And the earnings, and therefore the ROE, came under some pressure. Well, that was the first thing that happened. The fair market value, they slipped under that SG price level there and got under pressure, under pressure, under pressure. The second thing that happened was that as the earnings slipped, the earnings actually slipped below the dividend, and therefore the company was paying out too much money. And there was therefore even greater downwards pressure on both the stock price and the balance sheet, which you can see was steadily slipping. Well, it dropped all the way to its growth price. We thought that it might rebound there, but the fair market value was still plunging. They did cut the dividend in half, so that was a help. But then, of course, that meant that BCE was not nearly so attractive, and the shares have slipped further under the growth price. Now, they're trading right now between their growth price, that's $36, and the high conservation price, $26. Now, I don't like to buy shares between breakpoints. I either like to buy them at the breakpoints, or if they move up and then break out again, I like to buy there. I don't like to buy shares in between, and as a consequence, right now, I would not touch that share. Well, you might say, well, wait a minute, now, if you're not going to recommend BCE, what about Telus? Hey, look at that. It's got a nice yield of 7.6%. But look, at the earnings are $1.08 and the dividend's $1.66. Okay, its dividend isn't covered either. So we are probably facing a dividend cut here. In the meantime, again, they're under pressure to share their platform with those little tiddler companies. And what we are seeing here is the balance sheet falling. So 3 strikes against the shares. The balance sheet is slipping. The dividend is not covered. And the shares are already selling at their fair market value. So what upside is there for you? Unfortunately, therefore, I have to say I would not switch BCE for Telus. I hope that that has helped your thinking about BCE and probably about Telus as well. In the meantime, have a good week, and I will see you next Friday.